The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
Well, whenever there's a change at the top, it has investors second guessing. So I thought our stock of the day, we should take a look at Nine Entertainment after Mike Sneesby, the chief executive, resigned this morning. CFO Matt Stanton will act as interim CEO as the board seeks a replacement for Mike Sneesby. His resignation comes as the company conducts a review into workplace culture and amidst a tough media landscape with advertising revenue down. Chair Catherine West acknowledged Sneesby's achievements in building the streaming service Stan. That's where he actually came from before taking on the top job at the parent company. Let's take a look at Nine shares this morning. The reaction down about 5%, but of course, like most of the big media stocks, off a very low base, down to $1.19 at Nine Entertainment share price. Mark Gardner, a change at the top here. Does that make you second guess or reevaluate Nine?
Not really, no. I mean, look, I understand why it's down 5%. I mean, sort of kicking the stock while it's down sort of thing. Yeah. Look, it's a tough job, realistically. I mean, Stan was a bright spot, obviously. There's a lot of legacy businesses in here, and they've gone and combined a lot of legacy businesses now. It's multi-channel.
So you got radio, TV, streaming, newspapers.
So, and look, media's had one of the biggest overhauls, of any industry, realistically, over the last probably couple of decades. And look, there's maybe more to come as well. AI is going to really affect that as well. This is a business I've really wanted to like over the last couple of years, but every time I'm encouraged to buy it, I mean, looking at that, you have a look at that chart there, and if you pan it out to 5 years, I mean, it's roughly the same trend. I just thank the Lord that I haven't tried to catch the falling knife on this one. But I like what they're doing. It's just, I think that it's just a tough job, basically. I mean, at some juncture, the infrastructure that they've got and the multi-channel business model is going to be fantastic because obviously, businesses won't accept anymore, when you can go and pay per click and you can get return on equity on your investment in your market and on your marketing costs and things like that. The days of walking in and going, we're going to make you $1 million ad, you're going to spend millions and who knows what you're going to get back in return are just kind of gone. So it makes it very difficult. But having the multi-channel thing now, I believe at some stage they'll be able to obviously offer the customer a better spend, and they'll be able to compete a little bit better with online as well. I think this is just a stock that's been under pressure, and more bad news has probably hit it hard. Again, I mean,
you just avoid.
It's not that I like the company,
right?
But I mean, like I said, I liked the company a year ago, and I was just very disciplined in trying to not catch the fall.
So if you're in it,
I think if you're in it and you've worn this pain, you're probably staying in it overall. Right. I think it's probably it's probably cheap here, but it could be a while basically. Okay. But I do like the structural changes that they've done. New CEO, I mean, who knows what I don't know whether it makes a huge amount of difference. Because obviously their star has been Stan, and he was running Stan. So I think those getting those legacy businesses to all combine is probably it's at least a couple of year project.
See, I don't know. Maybe I'm too close to the media. Streaming services, are they stars? They don't get any eyeballs. All the eyeballs, excuse me, in newspapers, TV, and things like. It's how they, I reckon, restructure that old school business model. Because
I think that's far more important than Stan is overall. But it's the growth story within the stock, whereas no one wants to talk about the old school business. But if they get this old school business right and make themselves a multi-stream, I think there is significant upside. But I just don't see it happening in the next 12 months.
Daniel, What do you think? Of course, in Melbourne, they own the Melbourne Age, 3AW, of course, Channel 9.
Yeah, very comprehensive overview between the two of you. So, look, I don't think I'll add too much more, but what I will add is, and I speak about this every time these stocks come up, is just being very wary of the fixed costs in these business and the operating leverage. Like we've seen in the down years, 3% decline in revenue this period, 30% decline in profit. So, I mean, we get really excited because a lot of investors, and I think it's, one of the downside of investing, perhaps the simplicity of it, you're just looking at headline figures, maybe trailing yields, trailing PEs, and, they don't represent, fundamental values of companies and the outlooks to a very good degree. I mean, literally a 10x impact on leverage to the bottom line for this business. So when things are going the other way, I think we have a tendency to underappreciate how bad it can get and probably overappreciate how good it can get on the upside. So, yeah, I mean, I'm probably going to go down the Mathan camp here and say, look, you buy it on the first upgrade if you want to be in this industry. But what I will say is, I actually had a look at some of the radio companies like ARN, and they actually reported pretty well. It's just that there's no investor interest in those stocks. Like they actually beat expectations and had a pretty decent result. It's just literally no one is interested in buying those stocks at the moment, and all the corporate shenanigans at the moment isn't helping either. So there are industries, pockets of this industry which are doing okay, probably better than expected. But yeah, when you don't have that market appreciation on your side, and flow is something we'll talk about a lot today, it's very hard to do well in this market.
I've always thought, because they still get big numbers of people. If you can capture who they are and their details, you've got to diversify away from just advertising because that's so secular and also, the easy way just to go to Google ads now and stuff like that. But I've often thought these media companies should start selling stuff themselves rather than just advertise Harvey Norman. Buy $20 million worth of sofas and become a Harvey Norman franchisee and sell them direct and become a retail merchant.
Yeah, just leverage off that base.
They've just got to break the model away from just advertising to flog stuff.
I certainly don't have the answers, but I think thinking outside the box, because that foundation, they've got a lot of eyeballs and a lot of power.
Yeah. Yeah.
I think just quickly, Koshi's been seeing the share price of Wesfarmers and JB Hi-Fi just continue to climb and thinking I wouldn't mind participating in that a little bit. It's just dominating at the moment, but it's an interesting idea. It definitely has potential.
Yeah. All right. Okay. That's Nine Entertainment, our stock of the day.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.